conjunction with Biz Talk Today TV and CrossCheck Media. Welcome everyone to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and it's got to be very hot Scottsdale, Arizona.
That's why I'm wearing a freaking, sweater.
You got that air conditioning running, I'm sure.
Because the air conditioning is like, I'm freezing here, and if I walk out, I'll be warm in 13 seconds.
There you go. Well, with us today is a very special featured guest who's coming back to Buy, Hold, Sell. Sam Stovall. He is the Chief Investment Strategist at CFRA Research. Sam, last time we had you on the show, you gave us a bullish forecast for the S&P 500. You have revised it higher. Are we going to see markets go even higher than your prognosis right now?
Well, Todd, the prognosis is that we will hit 5610 by this time next year, which is about an 8.5% price appreciation. So when you look at it on a percentage change basis, I'm not really sticking my neck out that far. But what I do with price targets is look at it more as a weather vane than a laser beam. What it does is it gives some sort of guidance to our analysts so that when they come up with a target price for a stock based on our proprietary discount model, then if it's above my forecast, then they make it a buy. If it's below, they make it a sell. So it's revised fairly frequently to make sure that we are still looking 12 months down the road.
Yes, Sam, but when you put your forecast together, obviously you have an earnings per share number that you think we're going to hit on this. And this, I assume we're talking about the S&P 500, correct?
Correct, yes.
So do you factor in, though, because there's only two camps now. There's no rate cuts or there's two rate cuts. Which camp do you fall into?
I fall into the two rate cuts with an asterisk, meaning that if I am not totally confident, it means that I think there'll be one rate cut taking place in December. Our forecast is that we are likely to be seeing the yield of the 10-year note come on down, that we are going to continue to see a downward trend in inflation. And yes, every election year since 1992, except 2012, had the Fed either raise or lower rates before the election, with many of those rate changes occurring in September. So I think the Fed would love the opportunity to show the markets that they are apolitical.
Okay, hold on though. What is going to determine this? Because right now, we have the jobs report coming out on Friday, but jobs have been strong all year long. There isn't anything that's showing us right now, especially when you see inflation, you're not hitting that 2% target that the Fed so desperately wants. So what exactly, do you see the economy just really heading south into the third and fourth quarter to warrant a rate cut?
I don't think that we're going to have to fall into recession in order to have the Fed decide to ease off on their higher for longer stance. When you think about it, what the Fed does today isn't really going to be felt for 18 months. And so it's almost like a destroyer aiming for a target that's below the horizon. So what they want to do is ensure that they're not going to be throwing the economy into recession. Our expectation is that we probably end up seeing economic growth at about 2% by the end of this year, and continuing to dip a bit into 2025. We think unemployment will be creeping its way higher up to about 4.2% by the end of next year. And we are likely to see the 10-year note go back and challenge the 4% level once again over the next 12 plus months. So, we'll have to wait and see if the economic forecasts are correct. Right now, I think that we are continuing to see investors gravitate toward the growthier areas of the market.
Well, we have there's a lot of stuff packed in there, Samuel. The first one is the counter to that is that if you take these indicators and let's just say, for Pete's sake, we actually use after inflation numbers as opposed to these jigged up numbers, but there's a stagflation theory or thesis out there that, in essence, we're going to see. I think the jobs number we're going to see is going slowly down. The employment rate is slowly going up. The Fed is not budged on the 2%. It's not 2.1. It's not 2.2. it's 2%, or CPE, do or die.
Yeah.
Otherwise, they lose credibility. And then somebody from the White House calls and says, "Hey, do you know what the hell you guys are doing? Economy's starting to go a little slower. How about you throw in a little dice here?" That to me is sort of what you're saying, that they'll succumb to the normal presidential election cycle and do something positive. Am I dismembering your thesis there?
Well, I had a feeling you were going to be pushing back when you called me Samuel. Sounded like I was in the doghouse already.
Right.
Maybe it's a bit of a Pollyannish approach, but basically when it comes to economic forecasts, I leave that to the dismal science and to our economists. And my belief is, let's take a look at where the earnings are expected to be, where interest rates are likely to go, and not putting the cart before the horse. I say, let's take a look at sector rotation, if there is any rotation, to see what the market is anticipating at this point. And I think right now, you have tech and semiconductors that are being driven by AI, but you have the rest of the market that's being driven by EI, and there's no O on the end. So earnings and inflation. And so with us being in a pause period from an earnings perspective, the focus is going to be on inflation. And right now, I think we're sort of in limbo, waiting to parse some of the commentary that the Fed will be giving us quite shortly to see whether they are inclined to cut rates sometime this year or wait till next year.
Well, how about the fact that we just ran so far, so fast, so many trillions of dollars in such a short time? How about a good old digestion period?
I absolutely agree with you. I mean,
Okay.
we have what, 24 new all-time highs this year, 22 of them by the market peak on March 28th in that first quarter. We were up 10.2%, which was the 11th best first quarter since World War II. And of the 15 best first quarters, we ended up 14 times. We ended up with a decline of 5+%, which we just got and recovered from. But I think we didn't get in a sense got away with murder, and I think that we are going to see another decline of 5% plus to help reset the dials. But I'll leave you with a positive thought on the thought about the corrections and whatnot is, if we have a low by July 31, we have never posted a decline for the entire year. So 86% of all years since World War II had year-to-date declines. And if the low point occurred before July 31, we were in the green 100% of the time.
Todd, you can just call me the Stovall setup man.
That was perfect.
I pitched a hard ball and he freaking knocked it out of the park. Holy mackerel.
So hold it. So we hit the lower low, the lowest the mark of the year before July 31st. Markets by December 31st, 100% of the time end up higher.
Correct.
Okay. But what about, that's great. But the last time we had you on the show, you talked about the election year cycle. And now, I know this show's not about politics. I don't care what your political affiliation is. But historically, we've seen stocks actually rally during election year cycles, especially when there's an incumbent who's running for that second term. How do you see it, though, this year? Because right now, the numbers really are a little bit shaky.
Yes, they are. Yes, I won't quote. I'll just quote Will Rogers, who once said, "I don't belong to any organized political party. I'm a Democrat." But I will quote the economic cycle and the presidential cycle, that every election year since World War II that started with a positive January, we saw an average annual gain of 15.6%, with the market higher 100% of the time. Obviously, that's not a guarantee, but a very reassuring statistic. At the same time, however, if you look to performances from Memorial Day through Labor Day, basically the market treads water, up only 1.6%. And really, it's a coin toss as to whether the market is higher or lower. But we do end up with a Q4 gain of about 3.5% to 4% because the uncertainty has concluded. Now, it is interesting that heading into the election day itself, the market usually is down about 1.1% since World War II. But what's interesting is from July 31 through October 31, if the market is up, the incumbent traditionally gets reelected. If the market is down, the incumbent gets replaced. And especially with a decline that's failed only once in 1956 when Eisenhower beat Adlai Stevenson, not because the indicator was wrong, but because we had two geopolitical events take place in October. Gamal Nasser seized control of the Suez Canal that prompted a military response by Britain and France. And we had the Hungarian uprising that was crushed when Soviet tanks rolled into Budapest. So if we end up with some sort of a geopolitical event heading into the election, that could throw off the indicators. But usually a positive is good for the incumbent, a negative is good for the challenger.
Yeah, Todd, I'll let you know that my AI system is taking everything that Stovall just said and checking it in real time. And so far, he's about 28 for 28 of his claims. So I'm going to take it. Let me play the other side of this just for a second. In history, because you know all this stuff, I don't know what's going on in that brain, but the level of concentration and the stock concentration that actually has delivered the performance so far is astonishing. I can't go back other than in 1999 and to see, 15 stocks that drove 71%, I believe, of the appreciation that year. Here we are, they've driven about 64%, right? So if one of those cracks, obviously it's NVIDIA's market and we're just, playing in it. If NVIDIA does throws a wrench, doesn't that, then all bets are off?
Well, I think, in many ways, you're right. We did have the nifty 50 back in the late 60s, early 70s, but at least there were 50.
Right.
We're not talking about 7. And now the worry is that the MAG 7 becomes the lag 7. And even point to utilities. You take out the 3 best performing utilities out of the entire index of 31 companies, and you have an underperforming sector. So yes, that is a concern, but it's almost like the boy who cried wolf. If you cry wolf for 2 or 3 years and then something does happen, do you still get credit for it, or do you get blamed because you missed the 25% gain in 2023 and right now the 10.5% advance in 2024? So that's why I think I look to fundamentals and technicals, because fundamentals tell you what, but technicals tell you when and how far.
Okay, Marco Galvin. Okay, I understand what you're trying to say here. The concentration to me is somewhat reflective of the power of the new industrial revolution here. Nobody's smoking dope here. What I do go back to is that the hype on what AI is going to do for corporations in the next 6 to 12 months, every CEO, every public company I know is saying, you know what, Toby, we don't know what the F is going to happen with this doing. All I know is we got to effing do it. And that's sort of where they are right now. There's, the idea that you're going to use your co-pilot and say, hey, co-pilot, how much did Sam get right? And they're going to feed it back to you. A, that's not happening. I have it going through a system that is taking the transcript and then checks against ChatGPT, right?
Yeah.
Well, what does that do? It doesn't come back and say, no, Stovall's wrong. Actually, if you look at blah, blah, blah. So it's garbage in, garbage out. The half of the people we've surveyed who are using Copilot that are paying $30 a month for it say it's worthless for them. Doesn't do anything for them. It actually sort of just gives them something to play with while they're doing other things. So the hype cycle, you've been through it. I've been through it. Of course, you being born in 1894, you went through some of the hype cycles that radio thing was never going to work, right? Those moving pictures. Who wants to see color pictures, right?
Right. and putting a radio into your horse and buggy, that's crazy.
Who would think of such a thing?
It'll bother the horse. I mean, we're crying out loud.
That's great. That's great.
I mean, you're bringing up a good point because, I mean, I was around in the late 1990s when everybody thought that the market was inexpensive at 60 times forward estimates.
Right.
I mean, right now, I think that we are seeing tech bump up against that 30 PE, which has sort of acted as a very strong resistance level. But our expectation is that we're going to be seeing very strong earnings growth in the years ahead. I'm just going to quote you some of the statistics that Angelo Zeno, our tech sector group head, has been sharing with me, that data growth in the last 4 to 5 years has exceeded the data growth in the last 4.5
decade.
Yeah. Annual spend on Gen AI will exceed $1 trillion in the next decade, and AI is going to drive sustained 20+% annual growth, with the cloud and semis being the biggest beneficiaries. So basically, the thought is that there is good growth ahead, sort of like now. I mean, we take the internet for granted, but in the late 1990s, the internet was going to drive everything. And yeah, it does, but it didn't really warrant the kind of valuations that we got back then. So I think our belief is that we are in the emerging period of AI and generative AI, et cetera. But we will have to be realistic when it comes to valuations.
Right. Yeah, well, the other thing I'd add, Todd, is that at the same time this happened, we're at the same time where 15,000 boomers turn 65 or 70 every day, that we're 5.5 to 8 million people short of workers in this economy. Europe is worse. And, this generational transformation of boomers with hair like mine, is going to, you need productivity boost. If we don't, then we have the economies that are going to be going in reverse, simply because consumption will not be as strong as it would be with the missing workers. So
I think that's one reason why we really have not seen a rotation out of the US with its high PE ratios into Europe or elsewhere, is because their demographic situation is even worse than ours. I mean, they're trading at a 20% discount to their long-term relative PE versus the 500. But investors don't really seem to care. US dollar remains strong. ECB is likely to cut rates, making the dollar even more attractive because of higher yields, et cetera. So, if you are a believer in reversion to the mean, that reversion will probably continue to take a long time.
Yeah, you got that right. Listen, let's leave it there on that block, guys. And because there's so much to talk about, we could talk about AI for hours, obviously, because everybody else on Wall Street is as well. But with us today, we have Sam Stovall. He is the Chief Investment Strategist at CFRA Research. He's going to be coming back after the commercial break, and he's going to tell us all kinds of surprises. He might even tell us his favorite sectors. Who knows? He'll even get into some algo trading, because I know Toby wants to address that issue as well. But please stick with us today on Buy, Hold, Sell. We'll be right back.
Keep taking the Quaaludes. Would you just calm Bill down a little bit?
Buy, Hold, Sell, brought to you by CrossCheck Management.
We give game day a whole new meaning.
Welcome back to Buy, Hold, Sell. I am your trader, Todd Schoenberger, joined by my friend and co-host Tobin Smith, and with us today a very special guest, Sam Stovall. He is the Chief Investment Strategist at CFRA Research. Sam was just telling us in the last block how he lifted his S&P forecast for the next rolling 12-month period. It seems there's a lot of optimists out there, Sam, right now that are really changing. Mike Wilson from Morgan Stanley is now turning bullish. I think the only bear out there now is still Dave Rosenberg. But do you take...
No, Kalanovic is also bearish.
Okay. Yeah. But when you see people switching sides like that and becoming more bullish, does that factor into your equation? I mean, do you start feeling a little bit nervous that, hey, we might be at a top?
Well, I do obviously pay attention to what is going on around. The AAII poll just came out showing that you have investors who are more heavily weighted to equities than they've been in 2.5 years. And so as a result, that is a bit of a concern in the near term. And so I think that we, as I had said in the first half of this program, that I think we are due for a decline in excess of 5%. 8 of the 15 times that we had the first quarter that was in the top 15, we had 2 declines of 5% or more that took place in that calendar year. But as I had mentioned before, you get the negative out of the way by July 31, and the market has traditionally been able to work its way back higher by the end of the year.
Sam, is it an apples and apples comparison if this happened 40 years ago, but there was no market cap weighted indexes, or there were no ETFs that traded on market cap indexes, and now 61% of the number better than I do are in some form of a index that is market cap weighted, because it feels that to me. I'm in the camp that has changed how stocks trade in the writ large sense. I don't know. I'm not excited about making a comparison between today and 40 years ago, when there was no ETFs and there was no market cap ETFs, except for the S&P 500 and Dow.
Right. Yeah. When Vanguard came out in 75, so 50 years ago, we did have a market cap weighted benchmark available to investors. But I think what you're basically asking is, or saying, that history ain't what it used to be. And so the question is, do we really look upon history? It's a great guide. It's never gospel. But there's one thing that has been consistent throughout every bull and bear market in history, and that is human reaction.
Yeah.
That emotions are typically what drive investors, and they really should be listening to Clint Eastwood, who said, "Man's got to know his limitations." And
man's got to know his limitations. Yeah.
And in this day and age of instant information, they can experience both fear and greed at the exact same moment. So I think once you start getting the market going down, then these fear factors kick in. A little statistic you can look up later on is that in bull markets, only 15% of the trading days had 1% or more volatility. But during bear markets, 45% of those days were either up or down by 1% or more. So volatility is more of a coincident indicator, and it is a measurement of investors' fears.
Hey, where do you sit on the 1-day options that are skewing the VIX? So the VIX doesn't tell us anything anymore. You have an opinion on everything. So what do you think of that one?
Well, I really haven't followed that too much, so my opinion will be, I'll leave that up to you.
Good answer. So
good. I get 1 out of 40 for crying out loud.
So at CFRA, I mean, you guys are around. You guys are brilliant Wall Street minds. You guys are talking about sectors and which areas to really be favor and which ones are out of favor. Right now, where does CFRA stand as far as the top sectors to be in for the rest of 2024?
Well, again, our targets are 12 months down the road. So that would be by around this time next year. We're still overweighting communication services, technology, and financials. And our belief is that when we look to basically 2 things when we come up with our sector recommendations, our analysts' recommendations in terms of what percent of the constituents within the S&P 500 have buy or strong buy recommendations. So a higher than average percentage sort of leans in that direction. Also, what is the cap weighted stars ranking? And if that cap weighted stars is above average, then again, there is favorable recommendations. We do have a technical analysis arm called Lowry Research, and we use technical analysis at the same time to come up with some guidance, probably more in the near term, to say where there are some emerging opportunities. So I would say that in the near term, you might want to be looking toward Lowry. Right now, they have indicated that there's an improvement in the materials area, also in industrials, and in particular in the aerospace and defense area. I think one reason is because with the elections ahead, whether the Democrats or the Republicans emerge victorious, there will be increased defense spending as we try to maintain our position within an increasingly challenging geopolitical environment.
Yeah, Todd, I'll tell you that, I'm sort of a slave to the 52-week highs and lows charts. I've literally, I'm looking at the Wall Street Journal. I just keep finding that I'm an inflection investor, meaning I'm looking for a inflection of growth that came from a transformational event, either political, technological, or financial. And the one that gets me is, we've talked about the bifurcated population of the United States by income. That top 20%, I'm looking at, we've been owned long Amex for a long. Well, then I read now Gen Z kids they're going after for Amex. But cruises, Viking just went public. We're long Viking because these things are sold out. You know why? Because there's no freaking kids on it. There's no casinos. There's no pools.
The dollar is strong.
And the dollar is strong. I'm going to be in Barcelona next week. Our costs are about 15% lower just on the stronger dollar between when we made reservations and get there. And strong dollar doesn't always help the earnings of tech companies who are selling and repatriating money into, taking the EU and turning it into a strong dollar. So I'm finding the niches, Sam, that are interesting to me. And then the other one is affordability. I call it the deflation trade. And, BJ's Wholesale and Costco and, a variety of beneficiaries. And then, the food, the people aren't spending $30, to go out to dinner at the lower bottom. And they're not going to McDonald's for the $8 hamburger. But there's some companies that are really delivering a high value to the deflation needing person, the person who needs to lower their costs because they have a fixed income. And some of these companies are just knocking it out of the park. They just don't get they're not trillion-dollar market cap companies, so nobody cares.
Yeah. Hey, Sam, so the other day, Toby brought up a really good point about how the AI narrative is inviting so many younger investors now. A new generation is coming into play. Do you see that the younger people where are they consuming their information for knowledge? Are they going to places like CFRA? Are they just looking up everything online? Or are they just investing in Bitcoin? Where do you guys do studies on this? Because this changes the dynamic of Wall Street, if you think about it, from where we were just a couple of decades ago to now, where you have T+1, everything is instant. This new generation where they clearly have, I think they have ADHD, but where are they? Where do you see these people getting their knowledge from?
Well, I have been in sort of an advisory role with the Muhlenberg College Investment Society, and I got to say that these kids are intimidatingly smart. That a lot of them are doing their own programming with Python, et cetera. They are scouring the databases, looking for growth opportunities, et cetera. They're not afraid to be investing in NVIDIA and other very strong growth areas. No, they don't buy the meme stocks that are going to go up, and then when they decline, they're called mean stocks.
Yeah.
But
mean kitty.
But they will be focusing on those companies that they think longer term. It's sort of like what Peter Lynch said, invest in what you know. And these are the kids who they don't really know gold. They don't really know diversified chemicals. They do know technology.
Yeah. I would also add, Todd, that it is absolutely amazing if you go on some of the sites where you have AI investing strategies and programming. I literally created a program last week that I point and clicked on 6 different variables, click and said, then show me the stocks that fit this. And it cost no money. It was And it was not so much AI driven is that it was going after open databases, but to be able to then shape that and say, well, I compare this, change this variable and see how it turns out, change this variable. Man, you used to need 3 assistants in my day to put that together, and they had to be a spreadsheet jockey. There was no AI jockey.
Right.
And now with Python, you write your own program, back test it in real time, back test it anytime you want, and then the AI says, "Did you try this?" And it's scary good.
Yeah.
Absolutely. You sort of wonder if Ben Graham had a computer, would he be able to put in all of his 10 criteria for stock selection? How would he have done? But at the same, I mean, he would have done wonderfully because he was the only one doing it. But if everybody else is doing it at the same time, it sort of levels the playing field.
Well, the buy and hold allocation.
Todd, go ahead.
No, I'm just thinking the buy and hold allocation, the Charles Schwab's asset allocation, the 60-40 deal. That almost is in just maybe another generation away. It's going to be non-existent because you have so many people they're just continuously trading. And then you incorporate the algo side of it. You have to wonder how that's going to impact returns down the line. I mean, I'm speaking out, far out, but I'm just wondering now with AI, how that's introducing so many other more actively trading people, actively trading investors out there, and how that could actually impact returns down the line. But
sure, I was wondering about that because again, like if you have everybody who is, I mean, we have efficiencies or inefficiencies in the marketplace that investors try to exploit.
Yeah.
Well, if all information is knowledgeable and crunchable at the exact same time,
in real time,
then my thought would be that it's probably going to end up reducing volatility and therefore having it be more of a smooth upward trajectory based exclusively on earnings growth. And so maybe you'll have to have investors who are putting in their own tweaks to AI, or the problem is that a lot of times humans want to overrule the rules. But I think in general, if you've got computers that are using big data to crunch all the numbers, they're essentially going to come out with the same answers.
Right. And where does that leave values, Sam? Because, that guy you were talking about who did pretty well in the stock market, he's the one who taught Buffett to pick up dollar bills on the sidewalk or nickels on the sidewalk.
The dimes that that Rockefeller left.
Yeah. Where does, going back to your point, if earnings per share growth is what the algorithm looks for the most, which then pushes money into that sector or stock, which then creates momentum that the other algorithms are based on, where does that leave good old value investing? I mean, where does some of these guys go? Our friend Bob Olstein, for crying out loud, still running a value fund. But I was just looking at his portfolio last week, and he's got a lot of tech stocks, that are selling at 30, because if you're not, they take the money away, Todd.
Yeah.
When they give you the money and then their neighbor is kicking your ass in the market.
Yeah.
You go to where your neighbor.
Yeah. Well, that is a good question though, Sam. What do you think about that? I mean, for value investors?
Well, I think that maybe we end up with fewer true values and sidestep traps that value investors might have stepped in before AI. That we probably find that valuation differences end up narrowing. It really, again, comes down to how an investor will put their own spin onto this AI. But then since artificial intelligence learns as it goes along, it's like the old M5 from the Star Trek episode, or HAL from 2001. Interestingly enough, HAL is one letter away from IBM. And, so the concern is that maybe everybody's AI programs will be learning. And so, again, you really don't have anybody who has an advantage over anybody else.
I'm sorry, Sam. I can't do that.
That's just great. Well,
just to show you're not the only information nerd on this show. Or movie nerd or culture nerd. You're nerdy in so many ways. I think brain must fight each other for the nerdism that's coming out. We're not worthy.
Yeah, at least
Well,
I'm an extroverted nerd, which means I'll look at your shoes when I'm talking to you.
That's great.
All right, let's
That's
leave
great.
it there.
We're gonna leave it right
out of the
there.
park.
We have to leave it there because what a show. Sam always brings it, has actually thoughts, and they're always factual thoughts on every subject that we throw at him. So Sam, thank you once again for joining us today on Buy, Hold, Sell. We can't wait to have you back.
My pleasure. Thanks, Todd. Thanks, Tobin.
Absolutely. So on behalf of Sam Stovall and Tobin Smith, I am Todd Schoenberger. Please join us tomorrow on Buy, Hold, Sell. We have Wall Street Beat's Jeff Mackey. He's going to be joining the show for the first time. Looking forward to that conversation as well. So thanks again, and we'll catch you next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management.